Assalamu alaikum and welcome to a very exciting Ask Me Anything session. We've got two names who need no introduction today. We've got Aatif Awan, who, if I was to give a bit of a romanticized analogy, he is to the Pakistani startup ecosystem what perhaps Allama Iqbal was to Pakistan. He was a visionary. He is a visionary. Aatif's still alive. And what he's done in terms of laying the groundwork for the Pakistan startup ecosystem has been really trailblazing. His investments are the who's who of the Pakistani startup ecosystem. He is, of course, the founder of Indus Valley Capital. And he brings a very unique insight and vantage point. Of course, prior to this, he was at LinkedIn as well. So we're going to ask him, this is going to be an open floor. We're going to get a lot of questions from the audience and circle them to Aatif. And then we've got a few questions up on top where we're going to ask him about sort of his fund and 2024 outlook as well. So Aatif, thank you so much. We're very excited to have you here.
Thank you, Bilal. That's too kind of an introduction. I definitely don't see it that way, but we'll talk more about
It's
it.
also true. It's also how you're perceived, not just how you perceive yourself. But and then we've got Hammad. Hammad is actually one of the most interesting and exciting Pakistani Americans in the Bay Area from an investment perspective. He is an investor in Susa Ventures. Prior to this, he was an investment banker at Morgan Stanley. Susa Ventures, of course, has invested in some major fintech firms, including Robinhood, as well as Flexport, Mux, and Wiz.ai. He just brings his sort of career track and his journey, and we'll talk a little bit about that also, is extraordinary in terms of what he's able to do at the age that he's been able to do it at. So we're going to get a lot of insights from him and learn from him, as well as sort of understand his outlook. And you'll all have an opportunity to ask him questions as well. So thank you, Hammad, for coming here today. We're so excited to be able to chat with you.
Thanks for the kind introduction, Bilal, and it's the pleasure is all mine. So excited for this conversation.
Absolutely. And my name, of course, is Bilal Lakhani. I'm not Faisal Aftab, but if we can have a caretaker prime minister for 6 months, you can have a caretaker host for 60 minutes. So you've got to bear with me as we do this. And of course, a shout out to Ali and Paklaunch for helping us host and pull this together. I still don't know how he does this. But that is a story for a different podcast or conversation. So let's get started. Aatif, maybe I'll start with you. I just want to know a little bit for those who might be a little bit new, a little bit about your fund and also what your 2024 outlook is as we're early into the new year. So would love to kick off with that.
Sure. Thanks, Bilal. So Indus Valley Capital is the venture firm I started about 4 years ago. We are an early stage fund focused on Pakistan. So our vision has always been about realizing Pakistan's true potential through technology and entrepreneurship. And that's the dream. That's the big dream because, Pakistan feels like this land of unrealized potential. Throughout our lifetimes, you've seen, incredibly talented people, and yet, the economy doesn't grow the way it should. And I feel that technology is the way to do it. So what we do is we invest in early stage startups. Typically, we are leading the first round. So that can be a pre-seed round or seed round. But a simple way to think about it is this is the first $1 million that a startup is raising. We can probably do most of that and then bring some other co-investors along with us. We are sector agnostic. So obviously, when you are focused on one geography, you are taking that consideration risk. So we diversify that by investing across the board. So it could be e-commerce, it could be fintech, agri-tech, SaaS, what have you. And so far, we have made 15 investments across 2 funds. So we're on our fund 2. So it's a pretty concentrated investment strategy. So any given year, we're making about like 4 to 6 investments at max. And that allows us to work and partner very closely with founders. And that's the style we like because it takes a lot to build, in a market like Pakistan. And the opportunities are massive, but, it's going to be a years-long journey, probably a decade-long journey. And we want to be the earliest partner and have the time and bandwidth to be able to work with these founders. Now in 2024, real quick, I know we'll get a lot into the market cycle and how 2023 was as well. But we expect 2024 to continue to be a challenging year for Pakistan. I think it's getting better for US, especially because in US, the inflation is now coming down. The stock markets have recovered. So you have the beginnings of, a comeback, even though in US, and Hammad should talk more about that, it's far from over. But in Pakistan, because we are an emerging market, and even within emerging markets, like we come a bit later. So some people refer to it as frontier markets. It does mean that first the US and developed markets from a startup and VC standpoint have to recover. Then after a while, the emerging markets start to get more love, and then markets like Pakistan will start seeing US investors come back. So it is going to take some time. But the best part is, you look at the underlying metrics of startups and how they're doing. I think they're doing pretty well, and Pakistan's economy continues to come online. So that's what makes me optimistic and keeps us all going.
That's fascinating. And I really find your 2024 outlook very interesting, both sort of how you see Pakistan and sort of how you see sort of the US and sort of the rest of the world and that coming together. And we'll dive sort of a little bit deeper into some of the themes of your questions as we take audience questions as well. Hammad, let me come to you. And I actually want to begin by learning a little bit more about your journey, because it is such an extraordinary journey in such a quick time. So I'd love to hear a little bit about your background and how you got to where you are today. And then I'd love for you to talk a little bit about your 2024 outlook as well.
Absolutely. Happy to do that. So let me start out with myself. I was born in Pakistan. I grew up in Lahore, spent the first 18 years of my life there. Moved to the US, started college here on the East Coast. And after graduating, I jumped into finance, started investment banking in New York before moving to the Bay Area. And the move to the Bay Area started the interest in tech for me as well. So I was at Morgan Stanley for a number of years. Then I transitioned into late stage private markets investing, both minority and buyouts at Vista Equity Partners, which is a US-based private equity fund. And I joined Susa Ventures in the summer of 2021. So now I've been at the firm for about a little over 2 years. I can also give you a bit more context on the firm. We're based in San Francisco. We're a multi-stage early stage firm. So we have three fund families that we're currently investing out of. We have a pre-seed frontier tech fund that's more focused on government, defense, biotech, areas that haven't historically been key focus for us. Our core seed practice is a 125 million fund 4 that we're currently investing out of. And the big focus areas for us there are SaaS, digital health, supply chain logistics, fintech, AI, and dev tooling. And then we have a 250 million fund 2, which is an early growth vehicle where we invest in companies from Series A through Series C. And that one has a little bit of a narrower scope compared to our seed fund. So I spearhead our investment efforts on the early growth side, but certainly work very closely with my colleagues across the other funds as well. That's the quick overview, and happy to get into 2024. My perspectives on 2024. So I'll start off with the US perspective, and then maybe we can drill into the Pakistan angle a little bit as well. I think if we think about macro indicators of where the economy is heading, I think a number of important things for me is the rate cuts indicated by the Fed have certainly supercharged the investor sentiment, both in the public and private markets. So we expect that to be a positive tailwind for the venture market. It's unlikely that the IPO markets will open for the next 6 months. I imagine second half of this year to have more activity on the IPO side, which I think will give more confidence to late stage investors to start being a bit more aggressive in the market. I don't expect LP commitments to change pretty meaningfully in 2024, so it will be a relatively challenging fundraising cycle for VCs, which means that the bar for both early and mid-stage investments is going to be high, and people will continue to focus on areas that will be exciting and interesting for LPs. So I expect areas like AI, defense to continue to get a good amount of venture funding dollars, a higher proportion of it, certainly similar to what we saw in 2023. But I do think that it would be a little bit of a tale of two cities in the greater scheme of things. We expect some M&A acceleration when it comes to startup exit opportunities. I think if we do find some acceleration there, that would certainly make things more exciting for investors as we think about continued investment. And we're certainly seeing some sectors get a little more attention now than they did before, crypto being one of them. But I don't quite expect it to go back to 2019. The last thing I will say is I think the broader there's a broader expectation, and certainly something that I strongly believe in, which is that the buying market today has changed, regardless of whether you're selling to consumers or businesses or SMBs. The expectations of buyers today are very different from what they were before. And there was a thought back in 2021, 2022 that things will go back to what they used to look like. And I don't think that's necessarily going to be the case. I think there's been an evolution, and the buyers today of any products are keen to look for more differentiated products more so than ever. So the massive acceleration and just the breakneck pace of buying that was happening both on the consumer and enterprise side, I think is not going to come back in the same way. So there will be winners and there will be losers, but it's not going to be a uniform uplift that we saw sectors and markets and geographies get across the board. So let me pause there, but happy to dig into specifics.
No, that's fascinating. And I've got a lot of questions sort of coming out of that, but I want to take a few audience questions and then we'll sort of keep coming back and forth into this. So let me begin with sort of the overall macroeconomic sort of landscape and how that's sort of affecting some of this. There are two questions that are interrelated, so maybe I'll begin by asking these to both of you. One says, there are downsized rounds these days from a valuation perspective. What does that mean for the startup world? And also, considering the fundraising environment, what are your recommendations on how to stand out amongst the crowd? So sort of in a similar theme, but maybe Aatif, if I can get started on this with you, what does downsized sort of rounds or downsized valuations mean for the startup world in Pakistan, and how do you view that? And then in that landscape, how do you think founders should stand out or can stand out to you?
Yeah, that's a question everybody has these days. Now, at early stage, what's happened, if you look at last 4 or 5 years of Pakistani startup ecosystem, when things started around, late 2019, 2020, the seed stage rounds, the companies are being valued at 4 to 5 million, I would say, the median, some less, some more. In 2019, it was even lower, and then later 2020 it increased. 2021, I think it really started going up. So you saw 7 million, 8 million, then even 10, 12 at the peak. That is all corrected. Now I think we are back to 4 to 5 million, the first round valuation, and that's a good spot to be because you can still raise about $1 million at 20 to 25% valuation. Any less, and you just don't have enough capital to go and build enough to show product market fit and hire the people you need to. So that's where the market is at. I think, and then if you already had raised, that's where it's more challenging. And even from a raising perspective, if it's your first round, actually this is a great time to be building something as long as you can raise that initial round, because by the time you will need follow-on funding, I think the markets will be better. And you can control your destiny, right? Like you can control your burn, stretch this out to 3 years if you need to be. But if you've raised previously and now you're going into market, I think there is a real question about if your last round was raised at a valuation that didn't match your fundamentals just because the market supply demand was different. Now the founders have to figure out, if they need that additional capital, either you don't need it and you just wait and grow into that. But if you do need it, you have to get comfortable with doing down rounds in this market. And there's nothing wrong with that. And I think investors should also be comfortable with that. This is, temporary markdowns in your portfolio if the underlying company is good. But it's psychologically hard for both founders and investors, I would say, and it doesn't need to be. So it's very, very important to, just build for the long run. 10 years from now, it won't matter what a particular, Series A valuation was. And then that's very, very important for founders to keep in mind. In terms of standing out, I think that honestly for us hasn't changed that much, because ultimately it is a question of, are you solving a real problem? Is that market really, really large enough? And how do we know you are the best founders to do it? And there are things you need to do to signal all of that, and that still needs to be the case. If anything, like I have to answer, I guess just having more awareness of the capital markets and cycles, that helps. But I would put it, like under those three more important things that I mentioned.
That's fascinating. Hammad, I'm going to ask you sort of the same question here as well. How do you sort of view downsized rounds, and also how can founders stand out to you?
Absolutely. And I'll start off by saying I agree with everything that Aatif has said. I think he's absolutely spot on. We would expect the Alam Iqbal of startups to be. But here's a thought process that I would encourage folks to think about who've raised already. The single key question that you have to ask yourself is, have we built something that has differentiated product market fit today, or will have differentiated product market fit in the near future? And if you think that the journey that you embarked on when you raised your previous round has not quite panned out in the same way that you planned it, and you've had to take meaningful deviations that have extended the amount of time that you would need to get there, that's an important realization to have. Or alternatively, the realization that we may not ever be able to get there is also an important one. So when you actually go into the market for the next round and you're looking at a down round, you have to go through this thought process, because this will then inform what the best case decision making is for you. The reality is, and certainly we've seen this in companies that we've invested in as well, not every company is destined to be successful. We would certainly want all companies to be successful, but taking incremental capital when you know that it's the odds are strongly against your favor and wouldn't be able to get there even with the incremental capital, at that point down rounds are not going to help you at the end of the day. But if we're on the first path, hopefully, which is either our trajectory is great or we're a little behind, but we will eventually get there. At that point, managing morale of the organization and managing your own personal motivation and morale is more important than anything else. A down round is not the best outcome, but it's certainly not the worst outcome out there. Maybe you get diluted a little bit more, but at the end of the day, you are still building towards a much larger pie. And at the end of the day, these things are paper markups. And they don't, in the greater scheme of things, as Aatif said, they don't matter. So you have to think about what is right for the business and what makes the most sense, and do that, even if that means a little bit of short-term pain in terms of taking a down round. Do I think in the future, if you have great execution after raising a down round, will people look down on you or be hesitant to invest with you because you raised a down round? I don't think so. And I do strongly believe that you can create a very good narrative and story around capital efficiency, around having the wisdom and foresight to take a down round, of rejiggering your organization if needed around the down round, that will give people a lot of confidence in your leadership abilities to navigate a difficult environment and a difficult time. So do we expect more down rounds to happen? Certainly, but do I think they would absolutely be the startup killers or something that will damage the ecosystem for the long run, or a company for the long run? I don't think so.
Very interesting. And I think that's the insight that we get from speaking to both of you, that you can show a much more longer horizon in terms of how you view these questions than some of the folks in the ecosystem in the middle of it or in the middle of fundraising right now. So I think that this vantage point is very unique and helps us a lot. In a similar way, and there are one or two more questions on process, which says, any change in the investment process due to downturn and geopolitical issues, any changes in timelines. So would just be curious, and Hammad, maybe I can start with you this time. How does the downturn or even geopolitical issues, even if as you look at the U.S. market, whether it's U.S. China or the Middle East or even the U.S. elections, how do these affect your investment process, if in any way, and sort of the timing of your decisions as well?
So we've seen process timelines and decision-making timelines to have lengthened pretty meaningfully if we compare them back to 2020 or 2021. A seed round, and this is very US specific, seed rounds in the US back in 2020 and 2021 could realistically be done in 2 weeks. Today we're looking at a longer timeline. Anywhere from 3 to 4 weeks is pretty standard. And for early growth rounds, rounds that I look at, round fundraising processes can go on for a month and a half. So it's a lot of it's challenging for the founders because it certainly takes you away from your main job, which is running the business and building the business. And I do think there's a higher bar around things as well. It's just every piece of the process just gets a bit more extensive than it used to before. If you're convincing your partnership that it makes, it's an interesting investment, there's an interesting investment that you want to make, you have to spend a little more time just convincing them and going through different steps and different processes. If you're looking at the numbers of company, you're going through it with a finer tooth comb. Maybe you're talking to more customers, maybe you're doing more references. So all of those different components are just taking a little bit longer. So there isn't one particular new thing that has happened today that wasn't necessarily there in the past. It's just that the entire processes have just gotten a little bit longer. And I think the one piece of advice I have for founders on that perspective is know that things are going to take longer than what you anticipate them to take, and just strategize around who you're going to speak to, when, what your target, who your target firms are, how do you approach that, how do you structure your process in a way with that limits the excessive workload on you, how do you build out your data room in a way where people are not asking you for a bunch of one-off requests, and working with your existing investors if you've already raised a round to be able to get there. So in the moment when you are out in the market, it doesn't become a much more complicated task than it already is.
Very interesting. And then Aatif, if I come to you with the same question as well in terms of what's changed from a process standpoint for you.
So very similar to what Hammad said, the timelines have stretched for everyone. The numbers are different in Pakistan. I think even the seed round here probably is taking now 1 to 2 months rather than 3 to 4 weeks. It used to be, like faster, especially in 2021. And it's essentially a supply and demand thing when there was a lot of capital sloshing around, a lot more VCs investing. Things were just happening, that matching was happening faster. Now it's more time. Now, I think that's still fine. And like Hammad said, founders should plan for it. The key thing for Pakistani founders, I would say that seed round is still fine. It's the price round, especially the first price round that a startup does. That's where founders have a blind spot. They've seen their seed round happening relatively, in a short time span and not much legal paperwork. If you're raising on safes, which almost all seed rounds have been done, in Pakistan, all you do is sign this one document, 2 signatures, and the money gets wired from your lead investor. And then your price round is actually this 120-page legal document that lawyers spent, like 3 months on that. And most founders don't have that awareness. So I find myself telling a lot of founders this these days, even outside the portfolio, that if you have, let's say you're planning that you have a runway of, 12 months, for that next round, actually, you don't have 12 months. The investor conversations and getting somebody to lead the round and find other participants might take you 4 to 6 months in this market from Pakistan, and then add 3 months for the legal paperwork to do that. So you're cutting way too close. So you have to bake that in. So that's, I think, the key point, and the rest, what Hammad said, that's spot on, and the founders should be aware of that.
Cool. I find the consensus between both of you and your answers very interesting as well. So I'm going to switch it up a little bit and ask you slightly different questions. There's one question here that Aatif, I'm going to ask you, which is, what is the biggest tech story out of Pakistan in 2023? And Hammad, the version of this question that I'm going to ask you is, what is the biggest fintech story to come out of the US or in the world in 2023? Because if I said tech, you would say AI. So I think maybe we use fintech to switch it up a little bit. But Aatif, maybe if I can start with you, what do you think is the biggest tech story to come out of Pakistan in 2023?
I don't know if there is a single big one. I mean, if you had asked 2022, it would have been clearly the Cloudways getting acquired for $300 million. So we didn't have like one big news like that. If there is a theme, it is that it's been a tough year. So Pakistani startups raised $75 million in 2023, whereas the prior 2 years, it was $350 million. So step down, but if you compare it to the years prior, I think like it's still higher than that. So that would be the major theme. And then we had some startup failures as well in 2023. So that's within the same theme of the capital crunch. And obviously startups have to, like a lot of startups fail in Pakistan. In fact, not enough startups have failed, and we should get very comfortable with that. One thing that I would call out, so that was the negative side, but we have seen the startup ecosystem in Pakistan really diversify. So we look at seed, right? Early years, it was a lot of e-commerce, there was logistics, and that was very similar to, like what other emerging markets are doing. In 2023, it really diversified. So just, the kind of things we ended up investing in. So we've done a SaaS investment that's, like around payroll and HR SaaS, Pasmo. We have done Zip, which is they're making electric motorbikes and battery swapping technology in Pakistan, and they have it deployed. The team built in 10 months. We have invested in Voyage, which is focusing on not the inter-country within the country logistics, but actually the shipping abroad, and that exports team has been important. So I think that's been really great to see. And a lot of these new diverse ideas, you see that it's actually more experienced founders getting into the fray, which I find really interesting. But I was thinking about it, and then it kind of makes sense when early years, actually the risk profile for Pakistan was much higher because nothing had happened. You didn't have $350 million come in. So anybody who was thinking of building a startup in 2020, it was a crazy amount of risk to take because all those questions had to get answered. So you had a lot of younger founders in their 20s, kind of start companies. And then as that opportunity become clearer, we are seeing a lot more experienced founders, entering the fray as well. So not one story, but those are some of the themes that we have seen in 2023.
That's fascinating and very, very insightful. Hammad, I want to move to you. What do you think is the biggest fintech story that you've seen in the US or around the world?
Yeah, so two things I will highlight. The first one is the excitement around instant payments in the US. In some ways, the US fintech infrastructure has been relatively antiquated, especially when you compare it to the likes of Europe and even some emerging markets countries in certain areas. So instant payments was never something that we ever had in the US. You had things like PayPal and Venmo and Zelle and whatnot, but the settlement would always take a couple of days. So similar to the Brazil instant payment system and the one in India, FedNow launched in July. We're still in the very, very early innings, and they started off with a soft launch, but certainly see that to be a huge tailwind, especially when it comes to the evolution of what fintech companies would look like in the future in the US. So I think that is very exciting. The second part I will say, and I know you asked me this question to avoid generative AI, but unfortunately we can't avoid generative AI. So I will give you a second thing here as well. There's a lot of when you think about backend, especially when it relates to transfer of money, both in more verticalized environments and then broadly, there's a lot of manual documentation that's often involved, especially in sectors that are not super digitized. So supply chain logistics being one of them, insurance being another one of them. We're seeing a great amount of interest from founders to build AI-powered products and solutions that will help with manual documentation, which will help with making sure that the back end of payments generally is a lot more smoother today than it used to be before. And people may not have to do as many reconciliations in their accounting systems and go through a lot of that unnecessary work in the future. So certainly see a lot of great applications there in the US and abroad.
That's fascinating. And you're right, we can't avoid generative AI because there's actually a question related to that. So let me actually ask that as well to both of you. How has generative AI changed your investment thesis, if it has in any way? And maybe Atif, I can ask you this question. It'd be an interesting way to get a dip, and understand the pulse of how it's changing investment thesis or not yet.
So Hammad and I were actually talking about it at our last coffee meetup, and I'm sure that's already outdated. Things are changing so fast, especially in Bay Area. So for Pakistan, I think it's just not that rapid, but it's been very interesting. And really the way we look at it is we are sector agnostic. We want to see AI stuff happen more because that's I think a massive wave of disruption happening. So if you look at internet and then mobile, it's at that scale, right? And in some ways, it's just happening faster. And Pakistani founders should definitely take their piece of that. So the way we look at it is, in some cases, AI is core to the problem you're solving, and we love that. So for example, Farmdar is an agri-tech that uses machine learning on satellite maps to figure out which crops are planted where. It can predict yields, and they have these corporate customers. Recent partnership with Bayer and launched JV in Brazil as well. So very global product. And they were doing that even before, generative AI and the recent forms of AI came in. But that's core to them. We love it. Remote Base is another one where, it was a talent marketplace and they built this AI interviewer that can, take a job description, generate, like an interview plan, and then actually conduct the interview and do the assessment, right? So it's very core to the product. So we love that. Then every startup, I think, should be benefiting from generative AI in terms of their cost reduction. So that's been a common theme across our portfolio, where if you had customer support, you don't have to build it yourself. I mean, there's a lot of stuff that's happening, but you should be using it in Urdu, in localized languages. And whereas you're relying on a lot of call center, that cost should come down for your, like cost of sales, your content generation for SEO. So there's a lot of these core stuff that every startup needs to do to drive growth and serve customers. And AI can help do that better and at lower cost. So I think that, and developer productivity is a big piece of that as well. So we're already seeing that startups in our portfolio that have adopted GitHub Copilot, like fast, are seeing 30-40% improvements in productivity. So those are the two core buckets that we are seeing. But we are very excited about AI and we want to see more in our portfolio.
That's fascinating. Hammad, over to you on that.
Yeah, let me start off with the last thing that Aatif said. I actually, I'll make a prediction here. I think in 2024, we're going to start seeing publicly traded companies start announcing meaningful cost reductions and start to sort of associate certain components of cost reductions to applications of generative AI. I think in 23, there was a lot of, there was a lot of spend that went into it from an enterprise perspective, but we haven't quite seen the results we haven't quite seen the quantifiable ROI. So I think some of that is going to start to flow in. And once you start seeing public companies report it, talk about them in their earnings releases and in their conversations with analysts, I think that's going to give people a lot more confidence that this can happen even in the private markets as well. So strongly believe that using AI where you can, if you think you can, within your organization is absolutely going to be critical for building startups in the future. I think taking a step back and thinking about how generative AI has changed the investing landscape today and how we expect this to change in the future. I mean, the bottom line for me is there's 100 billion of spend that will get unlocked globally because of a generative AI. I think 30-ish billion of that is probably going to be in the US. And that's just based on just the percentage of jobs that we think will be impacted by generative AI. But when I say impacted, I don't mean replaced, but just supplemented by AI is probably a better call out there. It's going to be very interesting. We'll see a lot of value accrual going to some incumbents and a small subset of platforms. I think this is absolutely going to be true when we think about when we think about the infrastructure layers of it, and especially when we think about it more from a hardware perspective. But I think there's two things within the broader world of software. There's going to be specific areas, infrastructure companies that are focused on data consolidation, for example, governance, security, dev tools, generally developer productivity, skills training, LMSs. These kinds of verticals are going to get a huge boost from generative AI. I expect more venture funding to go into some of those sectors. And I do think that over time, we will start to see this becoming a differentiating factor. Today in the US, when we talk to any software startup, they will talk about initiatives that they have around AI. But I think buyers are getting smarter around what really moves the needle versus what is more marketing talk. And I think that's where some of that clearer differentiation is going to come in. One of the challenges we had broadly with the software market in the last couple of years, and why we had a lot of pain in 22 and 23, was because things feel very saturated, both from an investing perspective, also from a buyer's perspective. So I think this could be one of those big shifts where differentiation starts to become clearer, and the winners will be ones who are able to not just think about it from a more marketing perspective, which is certainly valuable, but really be able to implement it to show how they're different from the 10, 15 other people that are competing in the same market.
Wow. All right. Yeah, it's coming. Here we go. Then let's talk about something, probably the only thing that AI can't do, which is what is the best way to get introductions and build relationships with VCs? So that's an interesting question, and I'm hoping or assuming maybe that AI might not be able to do it. I might be proved wrong sooner than we expect. But Aatif, maybe to start with you, what's the best way for folks to get introduced to and build relationships with VCs?
So some founders try to build the relationship, like way sooner before they are ready to have the investor conversation. I don't recommend that. So VCs are typically really, really busy, unless you're doing something really cool that they've talked about, it naturally happens. That's great. Otherwise, like that doesn't work that well. But when you are ready, there are several channels that can work. And I'll talk about which ones are the best. So the best intro that you can get to a VC is from a founder they've invested in. Nothing beats that, right? Like if any of my portfolio founders sends me a company and says, look, this founding team is awesome, you should talk to them, they're getting to ahead of the queue, and I'll talk to them because great founders are, like a good judge of, they tend to know other good founders, and, they're selective in making these intros as well. Generally, we don't get a lot of these. Then the second one is, from any founders you respect. So I might not have invested, but I know them as a great founder. And then it would be through another VC that I've co-invested with. And then it could be anybody that I know, right? I do look at cold emails as well, and we have a form on our website, indus.vc. You can go and submit it. Actually, I recommend, sometimes people send WhatsApp messages, LinkedIn messages. Those are the worst because you don't have the tools to manage that inbox. So those get lost often. But email you can get to, but the website is better. So if it is cold, go through the website because that's our workflow. And it always helps to put yourself in the other person's shoes, whether you're doing a sales, whether you're hiring someone, whether you're raising investment, and see what does it look from their perspective. If it is just another LinkedIn message, it's very likely to get lost. But if I go through somebody that they know, and that's not always possible, then obviously, you'll get more attention. So think from that perspective, think about, what their core workflow is. If they have a form on website, chances are that there's a workflow that VC firm use, and use that if you can't get a warm intro.
Very cool. And that's very helpful. Hammad, what was your take on that?
Yeah, not much more to add there, to be honest with you. I totally agree with Aatif here. I think the strongest signal for us is when one of our founders tells us, hey, you should speak to this person. And the second one is for us is people that we've invested with in the past. Look, at the end of the day, this is a relationship business and this is a trust-based business. So a lot of you know, a lot of this comes down to, hey, we've worked with folks in the past and we trust them, and you know, they're likely to know and understand what we're looking for. So I would definitely recommend going for warm intros when you can over more sort of cold outreaches. Cold outreaches can help, but it ends up coming down to a differentiation thing, for me at least, or you know, without actually meeting someone or getting the right context. And a lot of times it's hard to see that in a LinkedIn message. It's hard to see that differentiation in a short blurb. But it can certainly work. I mean, you know, we take cold intros as well, but just you might have to put in a little bit of effort to make sure that you don't get drowned out.
Very interesting. All right. So I guess there's some things that AI cannot do yet. So we've got relationships, and the fact that both of you look at this still as a relationship business is also like important grounding, because sometimes we can forget that lens as well. All right. The next question, I'm going to merge two questions and you can sort of pick how you want to answer this. One is, what is your typical check size and investment stage? And two, what are some of the questions you ask founders before investing in their startups? So maybe Aatif, if I start with you, let's get your take and then we'll move to Hammad as well.
So I mentioned this earlier, early stage, typically the first round check size is around $1 million. That's the initial check size. And then we do have follow on. So about every dollar that we invest as the initial check, we have a dollar, you know, so half of our fund is marked for follow on. But that doesn't mean, you know, you're investing in each company, you know, like that follow on. So what happens is you invest in 10 companies and probably the best 4 to 5, you know, they tend to move faster as well. They'll have follow on rounds and we'll participate in those. Some of the questions, I think it's for us because we're so early, a lot of it is bet on the founders and obviously the market size. So we spend a fair bit of time on the problem they're solving, why they're solving that specific problem. You know, is there a personal connection? So founders, if that's a problem they've experienced themselves, you know, they tend to have unique insights into it. And that's usually something great, but it doesn't always have to be that way. We want to understand, and one thing to keep in mind is for founders that most problems, especially for a market like Pakistan, which is, you know, essentially the thesis is that economy is going online. It's been done in other emerging markets. So we have heard the same problem and market pitch many, many times, right? So we have our view, but we want to hear how you describe it, whether or not you bring any unique insight. You have a way of looking at it that's very different from other founders. That's very insightful, and it's giving us information on the team as much as that's giving us information on the market. We want to understand founders' background, you know, what brought them to this point. We don't care about the school you went to or where you work, but just in terms of, you know, like what kind of experiences you've accumulated, if any, and how do the founding team got together in the first place? You know, did they know each other for a while or not? So that tends to be important for us. And then, you know, we get into the details of what do they need in terms of capital and what their plan is, but that's, I think, tertiary and comes a bit later. And that's the stuff that's most likely to change. The market is, you know, like that understanding is more robust, and then the founders are who they are. So we spend a lot of time on those two things. And then the plan part is more to understand how much they've thought through what they want to build.
Very interesting. Hammad, over to you on that question.
Yeah, so on check sizes, our pre-seed fund will typically do check sizes around 250 to 500K. Our core seed fund invests 1 to 3 million in rounds, aiming to lead or co-lead. And then for our early growth practice, we aim to invest 10 to 15 million in a company. So those are roughly our check sizes. I won't cover a lot of what Aatif said because I agree with his perspective. So especially when focused on more early stage companies raising their first round of funding. So I can tell you a little bit more about what I would look at in addition to that for a more early growth company, a Series A, Series B company. looking for founders to demonstrate a deep understanding of the customer problem and the product ecosystem, to have a very, a good perspective on what the ROI is that they're delivering, understand and talk thoroughly about the usage and engagement on their product, understand the customer needs in a way that gives me a greater insight into the business. The ultimate question that I'm trying to ask is this company going to reach product market fit or not? Or are they already at product market fit? And if they are, what are the next steps from here on out? So a lot of the conversation revolves around that. And it revolves around what needs to be built out to be able to get there. What is happening on the sales team? How is it structured right now? What have you tried? What have you not tried? What would you try after this fundraising round? Is that something that would make sense for us? We do some quantitative work on the numbers and the data, and we use that to inform some of our questions as well, especially when you get into more of the details. And then similarly, you have conversations about the market as well, depth of the market, whether it's large enough, what is their specific angle, how are they playing that, what is the addressability of the product that they've built today, if they're planning on building a product too, how does that apply to the market today, what kind of feedback have they received from customers on some of those angles. All of these things are important, but I think at the end of the day, if I were to pick one thing that is more important than anything else for us, even at Series A or B, is founders. So the founder strength, founder quality, all of the things that Aatif talked about, those are all things that will continue to be important for us, even at the stage that we invest in. We're looking for growth mindsets. We're looking for strong storytelling skills. We're looking for a drive to win. We're looking for people who are excited and motivated to build a company, lead people, and be able to realize a vision and be able to articulate that vision, not just to us, but to their customers, to their investors. So at the end of the day, that's the one thing that matters the most. If that's not there and everything else is there, it's hard to get over the finish line.
That's fascinating. There's one more question related to that. Let me ask you both quickly on this, which is, what are some of the mistakes that even good founders make during initial conversations? So any mistakes that you think even good founders might make during an initial conversation that should be a watch out, that they might know through your advice? Any thoughts on that? Hammad, maybe we can start with you.
Sure. I've come across great founders who haven't quite planned out how they want to fundraise. So they will be flexible around timing, and they'll be flexible around the amount that they want to raise and all of those things. It's not our job to tell founders what to do from that perspective. We're actually looking for founders to have a plan in mind before they come in. So I think that's number one, and certainly see that with founders quite a bit. Folks who are very business oriented, not having a deep enough understanding of the product side, or folks who are very strong on the product side, not having a deep enough understanding on the go-to-market side, that can always be a little bit of a question. So would definitely recommend sort of polishing up on your storytelling, practicing your pitches before you come in. So I would say that's the second thing. And then the third thing is just broadly managing the process. If you're a great founder, you have a great story, it is still easy to feel confident, feel like things are going to come together. But any fundraising is a tedious process. It's also a little bit of a delicate process. So when you've committed to, finding someone to work with, partner with, when you find them, you gotta hit them at that point, and you gotta sort of close it for yourself and for them. Over optimizing for the additional 5%, for the additional 7%, either on the valuation side or how you're structuring the round. We've seen that actually backfire quite a lot even for the best founders. So would highly recommend not doing that.
Very interesting. Aatif, do you have anything to add on that?
Yeah, just one point on the valuation bit. I think the best founders don't make this mistake, but a lot of good first-time founders do, is they have a valuation conversation, sometimes too early in the process, but even at the right time. And then valuation, especially for a first round, like, you should not even be discussing that. It's an outcome of two constraints. So the founders should just talk about how much capital do they need to get to the next stage. So if you're just starting out, what do you need to hire those first few folks and build the product and get to product market fit. So you can go and then raise a Series A. Is that $1 million? Is that maybe it's a capital intensive business and you need to raise 2 million for that? Maybe you can get by half. So that's the input they should give. But sometimes founders would talk about the valuation. And the other constraint is VC's ownership. So again, having clarity on if you're talking to a VC, and you should ask those questions as well if you don't have that clarity in terms of what are your ownership targets. And you put those together and a valuation comes out of that. And in some cases, you would agree. In some cases, the math doesn't work out, and that's totally fine. It's a business transaction and a partnership conversation. So you can have that much more easily if you're not talking about valuation, even though mathematically the valuation is a byproduct of that.
Very, very interesting on those two constraints there. Then we've got the last couple of minutes. I'm going to try to do a bit of a Karan Johar hot seat, move through some questions a little bit quicker. Who do you both look up to in the investor space? I would like to pursue a path in VC. Any recommendations on what makes a good VC or what path to take? So any VCs that you look up to and what it takes to sort of become a VC. Aatif, I'm going to start with you there.
So one, there are lots of classical greats, and I do recommend studying them. So there is a book, Power Law, a recent book that goes into the entire history of VC. So anybody interested in VC should start there, read it. There's a very rich history of how it came about to be. But one I would mention is Mamoon, because he's closer to our community. Mamoon Hamid Pakistani. He led the turnaround of Kleiner Perkins. And it's amazing. Kleiner Perkins is this storied firm from the early days, like it's 50-year-old firm, and then invested in Google and Amazon. And then in between, when mobile came, they lost a step here and there. And then Mamoon and some other partners, came back 5-6 years ago. And it's been phenomenal. And Mamoon is an incredible investor, especially on enterprise SaaS. And very humble, very helpful. He's done, like a couple of Paklaunch events as well, spoken to this community. So really, I think like just study people, if there is a particular space you like, then you can find an investor in that space. But there is a lot of content these days available on how people think through these things. And there are different aspects of VC, starting from picking the right people, to how you think about different waves of technology, to portfolio construction. There's a lot of, like technical, tactical stuff as well. And there's content on all of that. So if you're interested, just, like look that up and study as much as possible.
Thank you. Hammad, your inspiration.
Yeah, I'll say I completely agree. I was actually my first thought was also Mamoon, but Aatif stole my answer. I think at the end of the day, there's a lot of great VCs out there, and I think a lot of all of them have made some great decisions and have some great aspects to them. So there isn't really one archetype or one person that you should absolutely follow and try to be that person, right? Peter Fenton is very different from Bill Gurley. Bill Gurley is very different from Fred Wilson. The way who's very different from Peter Thiel, for example. They all think very differently. They approach things differently. It might seem like they're sort of, they have some consensus ideas here and there, but at the end of the day, there's value, there's valuable insights that they're bringing in that could be very different from some other people. So find, look at everyone, see what they've done well, see what they haven't done well, and use that as a way to learn from them. I'll actually talk about a younger investor, just to step away from some of the more classics. And this is also in the Kleiner Perkins world, but Everett Randall is a good friend of mine. He heads growth for Kleiner Perkins now, used to be at Founders Fund before, and Bond before that, also a Vista alum. I love his depth of thinking. I love his ability to synthesize difficult, complex ideas and summarize them in a way where you can hit all the important points. And I love his way of thinking, of just being incredibly deep when it comes to his thought process. He doesn't write a lot, but when he does, it's some of the best work that I've seen. So if you come across him, definitely look into him as well. As far as path to VC is concerned, I don't think there's one path that is better than any other. I don't actually think there's a correlation between a certain path that someone has taken and their likelihood of success within that. You could be an investment banker, you could be an operator, you could be a founder, you could be a media personality, you could be anyone and be successful in venture. At the end of the day, what matters is, can you build up an awesome gut instinct and really sort of go after it. The advice, having said that, the advice that I usually give people is, instead of following the path that I did, which is a very finance heavy and very finance focused approach, becoming a domain expert can be very valuable, even if you end up being a generalist investor at the end of it. If you have some experience building a startup, that's incredibly valuable, because you'll be able to empathize with founders on some of the challenges that they face, because you've seen them yourself, even if you haven't been a founder. So I think having that operation or that operating experience can be very valuable. And then having the domain expertise on one thing that excites you, that you're, fired up about, that will differentiate you from, a lot of VCs out there.
Wonderful. Then the 3 minutes we have left, one last question. What has been your best investment? And looking back, why do you think you made that investment? I'd be curious to see if you both can actually answer that question. And if you can't, maybe then, what is the thing that you're most excited about in 2024? So maybe Aatif, to start with you, what do you think is your best investment? And looking back, why did you make that?
So one, I think it's too early. We've been in only 4 years. In VC is a very long-term game, so you only find this out in hindsight, and then it's also very hard to pick just one company. But look, I think we like ambitious founders. Our first two investments were Airlift and Bazaar. And those are very special, even though Airlift did not work out and Bazaar is on a very good trajectory. Between the two, both of them actually raised 100 million plus. So together, a quarter of all VC funding raised in Pakistan was by those two startups, right? So it's very ambitious founders. And we love that. I think just having that level of ambition and then the grit to go about it and bring together very talented, high talent density around that. And that's what's needed to really build something at scale. And I think they've both done that incredibly well. Amazing teams. And one of the things, the silver lining of Airlift's failure was that talent, it got dispersed into the ecosystem. And the best startups were actually very fast to, pick on that. There is a startup called Fleek. It's backed by Andreessen. It's not a Pakistani startup in the classical sense, but they have a team in Pakistan and they have their supply in Pakistan. Very quickly, they hired 2 or 3 really top tier Airlift talent. But that talent went into Truck It In, Easy Bike, Deal Cart, a lot of other companies, and we're seeing benefits of that. So definitely that's what we look for, incredibly talented founders who can also pull in other talent around them.
All right, Hammad, pick between your children or tell us one advice for startups for 2024.
I think one advice that I would give startups is reposition and reorient yourselves where you can. Look back at the business, take a step back, look at the business, look at where you are, look at where your cash balance is, look at what you need to achieve to get to the milestones that you have in mind for the next fundraise, or to be able to get to what the next stage of the company looks like, and be very tactical around what your budget, what your plan looks like for 2024 to be able to get there. We're getting to a world now where cash balances have dwindled for companies that raised in the last couple of years. Some budgets were stretched and, we were trying to make things work, but now we're getting to the point where companies realistically, maybe companies that raised in 2021, maybe now realistically have one shot at a big idea before they have to sort of go in more of a harvest mode. So if you are in that position, take a step back, have conversations with trusted people, think very tactically about your business and figure out what makes the most sense for you. If you have that shot, take it, because at the end of the day, you're trying to build something that against all odds, and you have to sort of put your best foot forward.
Awesome. Well, on that inspiring and insightful note, we're going to end this sort of riveting conversation that really, I think, helps us all get to a very good start in 2024. Hammad, Aatif, I can't thank you both enough. Thank you for spending your time with us today, and we appreciate you. And we're looking forward to having you back soon. Thank you both.
Thanks, Bilal, for hosting. It was a pleasure. Thank you, everyone.
Thanks for having me, and thank you, everyone. And thanks, Ali, for organizing this.
Thanks, Ali. Bye.